afternoon, everyone. First of all, my compliments to the team for putting up, PMS Bazaar team for putting up such a great show. I think the hall is full. So many people are paid to come here to listen to us. That gives good feeling. I'm sure you've been having great sessions since morning. A lot of people are sort of very, very esteemed panels. I saw the list and great speakers. So I'm sure you've been enjoying. What I would like to talk in next 10 or 15 minutes of time allotted to me is more about one of my favorite topic. A lot of people talk about, the basic quantitative or part of the, or finance part of the investing. But, as many wise people also suggested to us, investing is also big behavioral finance. How we act, how we behave, that is very, very, important, and that determines our outcome of investing. So, and this has been my favorite topic. And as you know, I run a firm called Carnelian, where we have grown in last 5 years from 150 crore to 10,000 crore, and we have had great performances across our products. One of the key reasons for that is that we follow this very, very closely. What has worked for us is not to necessarily fall into the narratives, but look beyond narratives. And I'll try to really elaborate that, how do you create, superior risk-adjusted return, looking beyond narratives. So, we all know that, human mind is very, Dan Kahneman, which is a great thinker, puts it very well. No one ever made a decision because of a number, but everybody needs a story. And that is true, that because when we are evaluating a company, investing is all about future. Right? Investing is never about history, it's all about future. What can happen in the future? And future, while we can all make, sense of numbers, but eventually we have to believe in a story. This can happen or that can happen, whether this company can grow or not grow. That is determined partly by the story, and human mind comprehends through those narratives and situations, right? They play a very, very big role in decision making. And why it happens is because, the way our neurons are designed is because we can relate to what is sort of, we can store information, we can relate to in form of a story, right? It catches our attention. So let's say today if I tell you that, while today I met a company which is very good in the retail space and looks very good, that's only one part of the story. But the moment I attach to it that probably it's the next trend in making, your attention will change very differently, right? Your attention will suddenly go, oh my God, because I am relating it to somebody, I am creating a narrative around that. It is a retail company, maybe it is rent or not, I don't know, right? It's only a narrative which I have created. And that narrative, ends up playing a big role in our decision making. The way, I remember a lot of people used to ask that, tell me what is the next HDFC bank, right? We have a lot of investors ask that. So these kind of narratives, get shaped in different shape and size, and that determines how we behave, how we take decisions. And James Montier puts it very, very nicely in his great book, book on behavioral insights, that we use X system for decision making, which is basically our default sort of option for decision processing information. Does not rely based on what he calls C system, which is more logical, data driven, because all of us are registering through the X system. And because it is effortless, it is intuitive, human mind always relate to what has happened in the past. So you need relatability to understand, conceive something. If I were to tell you today India is a great story, versus if I were to tell you India is a great story like what happened in 80s of US, suddenly your perspective will change and you will start looking at differently. Then you will say, okay, let me see what happened in 80s of US, and then you will start kind of evaluating very differently. So we need lots of narrative stories to create the picture of future in mind. And that is the real part, how we understand it. So that is where the opportunity and the risk both lies. So if you see, narratives build very, very fast, and especially in today's time, when the social media is very, prevalent, all of us are part of, I'm sure all of you sitting here are part of 10 WhatsApp group. If one narrative gets built, suddenly in next 5 minutes or 5 hours, it is there all over the place, and everybody starts seeing the same information, believing the same information. As a result of that narrative, so narrative starts building, and it becomes bigger and bigger, and by the time many people come to it, it becomes too late. So most of the retail fall prey to the narrative much later, right? Because it spreads, and then everybody is kind of falling prey to that. And because of the social media, this is becoming very, very short, very, very sort of quick. And as a result of that, you also see sort of momentum, stocks doing well, momentum, narratives doing very well. And narratives could relate to anything. It could relate to hindsight, it could relate to forward thinking. There are many ways of, sort of creating narratives. But let me, show you with a real example so that, you know what we can talk about. Like there was a time when big narrative was that quality can be bought at any price. Quality got determined based on the historical, ROE, ROC, and, and this narrative went on for at least, I think, 3-4 years, right? And in that, I know it got so deeply ingrained in people's psychology that, and people allocated large part of the money, especially between 2018 to 20 period. And that was a period where actually the real thing was, because Indian economy went through a difficult transition in 2014 to 18 through demonetization, GST, and many more structural reforms, they were investing alternatives were limited. As a result of that, select set of investments did well, and the narrative got created that quality at any price can be bought. And today we see that, and a lot of people allocated the capital, but in that quality at any price, in last 5 years have generated almost close to zero return when the markets have done very well. And just think about it in your mind, it was so prevalent. Every WhatsApp group would have some video around it, some talk around it, and few people who were promoting, got a serious amount of inflows around it. So this was, whereas I think quality at any price was a narrative. It was not basic of investing, but it was a narrative which worked for a limited period, and hence people fell into it. And same thing happened, right, post-pandemic, that new tech. Everybody would tell us the new tech, what stocks to buy, Paytms, Zomatos of the world, right? And I remember, policy bazaars of the world, and they IPO'd at, the price which I don't think many people understood, but everybody was investing because there was a narrative that this is the next big frontier of the growth. People were having FOMO, stock prices were doing, and say, oh, I missed it. There was a private market was building that, but we saw that how 22, 23, we lost a lot of money on that. Investors lost a lot of money on that, right? So again, where were these companies before, and how it happened only at that point in time? So if we see, and by the way, I can tell you, that point in time we used to say, and we wrote a note also, that this is a fad, people are investing out of FOMO, it will fade away. We never invested throughout the 21 in any of the new tech stocks, because we did not believe that fundamentally from a risk reward perspective it makes sense. It's there on our website. If you compare, there was a company called Latent View. Just because you call it a data analytics company, it does not sell 20 times revenue. Whereas we are used to investing 20 times PE, but people gave in a data analytics company which you kind of, and again, it's a good company. I'm not talking bad about the company. I'm just saying how market looked at it. Because data analytics became the thing, and because data analytics became the thing, people forgot the sense of valuation, and you ended up giving 20 times sales. Whereas you are used to investing 20 times P. And today you see how much returns it has created over the last 4 years, zero, negative rather, I would say. Like this. So all I'm just saying is that whenever as an investor, we have to constantly look at, is it narrative, is it reality, what is the risk reward of each of this. Same thing happened with the specialty chemical company. When some smart chemical companies figured out specialty chemical company is a great opportunity. But some smart companies figured out that if I call myself specialty chemical, my PE will double from 10 to 40 or quadruple. Nobody knew what is specialty chemical. Or most analysts, most investors didn't try to figure out difference between chemical and specialty chemical. But everybody wanted, because it is called specialty chemical, you invest into that. And as a result of that, we have seen what has happened in the last 2 years, 3 years. People invested a lot in 21, early 22, but lost. So these are some of the example of, and this, by the way, keeps happening again and again, again and again. And we as an investor have to constantly look at what is the basic. And I remember used to ask every company, आप करते क्या हो? Specialty क्यों हो आप? बताओ. What is specialty about you? That, you don't get much answer. So hence, you need to kind of constantly look beyond that. Some example of recent narratives I'll tell you, like when we launched our manufacturing fund in October 2020. What was the narrative? India can't be good in manufacturing. Bangladesh, Vietnam are far more, we have lost the game. India can never recover that. And today what has happened in last 4 years? Manufacturing has been one of the most great opportunity. Our fund has delivered 47% CAGR for last 4 years, beating market by 20%. Because we could see that we connected the dot, we saw on the ground what is happening, we spoke to 50 companies, everybody spoke different, but positively. So narrative does not have to be negative in the sense like, so today an ignored opportunity, but something is changing, you connect that and you invest into that, right? So that was there. CapEx cycle, by the way, till date, a lot of people ask a question, when will CapEx cycle pick up in India? Now think about it, CapEx has been doing very well, and I've been asked this question for 3 years, by the way, including last month one journalist asked me when the CapEx cycle will pick up in India. I said CapEx cycle is doing very well. Why are you saying CapEx cycle is not doing well? You know how they are determining the CapEx cycle is not doing well in India? Because historically, they are used to determine CapEx cycle based on the credit growth number of banks to the corporates. Now, credit growth corporates is not picking up, but point they missed this time around is that this time CapEx cycle is happening through equity funding, and internal accruals of the companies are so strong that they are funding out of the internal accruals. And we said, look at what is the other lead indicator of CapEx cycle? Order book of the companies. When we talk to company, every company is expanding, every company is saying, I'm expanding my capacity. So one side, the narrative is CapEx is not picking up. Other side, every company is saying, I'm expanding. Every capital goods company is saying, my order book is growing. But people were missing that. And this difference between the reality and narrative determined most capital goods stocks in last 1, 2, 3, 4 years have given phenomenal return. So when you look at things, beyond common, prevalent, and connect the dots, you end up getting a lot more ideas, right? Same thing, I think people have been saying markets are expensive. I mean, last 12 months, and just to realize that's how much returns we have kind of made. And according to me, markets are not expensive, and I don't want to go into that's a very long conversation, but we've been saying consistently, people who are making an argument that markets are expensive, only approaching from reversion to mean perspective. 17 का P पहले जायज़ था, आज 22 का P is not जायज़. Right? It will revert to mean. But in a transformating economy, which India is, it cannot revert to mean. In fact, mean keeps going up. It will never revert to mean, especially as long as transformation is going over next 5-10 years. So you can't call it India is great opportunity in transformating, but PE should be 17. Otherwise, it's expensive. Those people will keep missing because they are falling to the part of the narrative of reversion to mean, which has worked for last 30 years in India, which will not work in a transformating economy. Today, the common narrative is consumption is not picking up. Very common, right? You must have heard. In my opinion, how do you, just go check around yourself. Are people consuming less? How do you connect data? Real estate sales are going up. Cable sales are growing at 20%. Tiles are not growing. How do you connect this? Now, the equipment companies are creating this narrative because the market share is getting disrupted. But they are not going to come and say market shares are getting disrupted. But I don't think consumption is slowing. We need to see what is the internal change happening in the consumption. The problem is not consumption slowdown. Problem is the market internals are changing, and you need to think about it, right? So I just wanted to give you some idea about how to think about, what is the common narrative and go beyond, look at and how do we do it. Some of the, 3-4 things which we follow as a process so that helps us have unemotional focus on data and events. We connect everything, there's no, bias you have to have. You have to have complete unbiased focus on events. Like I'll give you an example. We became bullish on pharma only based on one event. Pharma companies from 2015 to 7-8 years were kind of not doing very well because US regulatory issues were there. And only one event changed our view. US FDA regulator, head of US FDA regulator, came to India, stayed in India for 15 days, met all the pharma companies. When would that happen? Because US was staring shortage of medicines because last 10 years no investor company invested. India has a 45% market share. That one single event determined that now pricing pressure will ease because they have come to woo the Indian companies. Please invest, and you see what has happened from there. One single event, you don't need a lot of research. Of course, you do company-wide research. So I think you focus, keep your eyes open, connect dots. You will find insights which is otherwise not available in this. So we constantly create that. Have complete determined focus on risk reward. very often narratives come, we say, अरे अभी मैं ले लेता हूँ, बाद में बेच के निकल जाऊँगा. It's like, for example, I was giving 20 times sales versus 20 times P. How do you expect to make money when you buy 20 times sales and you are believing only in bigger fool theory? Somebody will buy at 30 times sales or sales will grow and I'll make money. But that is not the risk reward in your favor. You are just being part of the narrative, and sometimes the challenge is that, when stocks do well, you feel missed out. But that's okay. It's okay to have missing opportunity which you don't understand. At least we are very comfortable missing out. We don't operate out of FOMO. Most people make fundamental mistake, including institutional investors. At the end of the day, they are also human beings when they fall prey to FOMO. Everybody else is doing, I need to do, hence I am doing. And lastly, but not least, I think you also, especially this is relevant for people who manage money for third party, but even, as an individual investor also, that you need to look good, right? When you go wrong, when you take a contra call, when you take a call against the crowd, when you take a call which is very different, and you go wrong, you get criticized very badly, right? And so how you look also is very important in this. We don't, at least we try to, that don't get impacted by that too much. You need to have guts to handle public perception, because ultimately investing is not, it's simple, but it's not easy. You are supposed to take call based on the limited information available. You are supposed to take call based on the data, and all we are doing is we are making hypothesis. We don't know whether something will be, will happen or not, but all we know is that based on certain data you have, what is the hypothesis of this succeeding, and if this succeeds, will I make more money, and if it does not succeed, will I lose money? So that is a broad risk reward framework, that if your hypothesis succeeds, you should make supernormal return. If it doesn't succeed, you should not lose a lot of money. And that is, to my mind, a risk reward framework. And when you invest beyond narratives, you are constantly evaluating any opportunity which comes to you on that risk reward framework, away from the clutter, away from the noise. So this is at least our thought, which has worked very well for us. I am not saying that that is right or wrong, but that is what has worked very well for us. So these are my thoughts. Thank you very much. My time is up. So thank you.